Have you been denied for a mortgage because you're self-employed and you write off too much money? This episode's for you. Hi, I'm Jonathan Wells, mortgage lender based out of Crown Point, Indiana. And today we're going to be doing a little series that I like to call Mortgage Myth Busting, where I go through a ton of different questions that people have or theories that they come up with or just ideas that people think is true about mortgage loans that actually are not. And so today we're going to be talking about specifically non-QM type mortgages and for self-employed borrowers or clients that just have their situation is a little bit outside of the norm, right? So without further ado, let's get into the video. Now, before we get into the video here, if you guys have been denied or you think that there's some kind of reason why you'll never get approved for a mortgage, drop the word myth in the comments. Would love to see what your thoughts are and how you may have gotten denied by somebody in the past or otherwise told that you couldn't qualify for a mortgage based off of your income. Also, please give a like and follow to this channel. It would greatly support me and help me get more content out like this to help demystify the mortgage experience and really get the word out there, specifically more business owners, that you can qualify for a home. Now, without further ado, let's get in the video. Okay, so I've got my notes up here for this because there's a lot of myths. I think we're going to go through about 15 of them today. I got my coffee as well, so I know it's going to be a really good day for us. So we're going to go through myth number one, that you need 2 years of tax returns to get a mortgage. That's simply not true. So when I've dealt with clients in the past, you can look at tax returns. Obviously, that is one of the ways you can help qualify a borrower. But we've also looked at things like bank statements. We've also done 1099 loans. We've done profit and loss loans as well. And you also have asset depletion and numerous other options as well for a client that may be self-employed, depending on the property type that they're looking at, right? So let's keep it very simple. If you are looking to purchase your primary residence and you're a business owner, right? And let's say you've still been in business for 2 years, but your tax returns, it's just not really, amazing, right? Like you're showing maybe you make like $30,000 or $40,000 a year. And in reality, you probably make about, $150,000 to $200,000 a year. Just that with all the write-offs and everything, you're bringing your taxable income down, which is the perks of being a business owner. Let's be honest. That's why, people get rewarded for taking the risk to go out and, carve their own path in the world, right? And for that, you get tax benefits. You're also employing a lot of people typically as well as a business owner. So there are a lot of ways for you to reduce your taxable income that are legal. It's just that when you're looking to apply for a mortgage loan, again, we're not showing that income, so we can't use that for you to actually qualify for the home that you want. So in this case, personal example of a client that I worked with, we were looking to do a refinance transaction, and he needed to pull money out of his house. He needed to pull about $200,000 out of his home. Now, he only owed about $146,000 on the home, and the home was worth about $500,000. So total loan amount, we're going to be about $350,000, $360,000. And, on his taxes, he's a truck driver, and he was making about $40,000 a year. So there's really no way that he was going to qualify for that new mortgage, with the income that he had. So what I did was I was talking with, my team and saying, okay, what different programs do we have? What can we put together for this guy? And we all decided that we would look at a bank statement loan to help him out. So since he was a business owner, he had a business bank account, and we just took the last 12 months of those bank statements. We averaged out his income. So we said, okay, he's getting deposited, roughly about $60,000 a month are getting deposited into his account from the various invoices, that he's receiving or that he's sending out, as a truck driver. And so you take those total average monthly deposits of about 60 grand, and then you multiply that by your expense ratio. So in most cases, that expense ratio is going to be 50%. If you have a CPA and that CPA can give you some form of documentation, typically it's a letter that would explain your actual business's expense ratio. Maybe, you're actually only spending 20% of your top line to bottom line, right? So you're netting 80%, or maybe you're netting 75%, or somewhere, anything over 50, right? If you're netting anywhere over 50%, your CPA can get you a letter, and we can look into using that to actually increase the income that we're seeing on those bank statements. But in this case, we just, we only needed the 50%, so we used that. Now we're showing that he makes $30,000 a month, which is in reality, actually what he's making. And so at that point, now we were able to go ahead and actually get that loan approved and get him closed before the end of last year. So that is myth number one, is that you do not need 2 years of tax returns to qualify for a mortgage. You can qualify with 12 months of bank statements, 24 months of bank statements, statements, and even other income options as well. Number 2, if you write off too much, you can't qualify. So this is myth number 2. And again, it kind of goes in line with number 1, right? Like a lot of these tax returns that you're going to be seeing, for most business owners, I don't even ask for tax returns anymore. I just go straight to the bank statements. Because again, if you have a good accountant and if you have half a brain, you're not paying a lot in taxes as a business owner. You're going to maximize everything that you can to lower that taxable income so that you're not paying anywhere close to what you need to be, right? And so most business owners that I see or that I deal with, their average income, I would say, is between $40,000 to $60,000. There are some that are on the higher end, right? Like I've seen business tax returns where the client's making $100,000 or $200,000 a year, but in reality, they're probably making closer to 7 figures because again, there's only so much you can write off, and the goal of every business owner is to keep their taxable income as low as possible. Now let's get into myth number 3, which is being self-employed leads to higher interest rates. So that's not entirely true, right? A lot of the non-qualified mortgage options like bank statement loans, P&L loans, 1099 loans, etc. Those loans that we're seeing now in the brokered world, right, or the non-QM world, the rates aren't really significantly higher than if you were just taking out a regular mortgage, right? You can do what's called buyer paid comp, or you can do lender paid comp. I'm not going to go into all of that right now, but essentially for all my clients that are self-employed that are doing non-QM loans, I'll give them the buyer paid compensation options because it allows them to get a lower interest rate while bringing a little bit of extra cash to the closing, and closing cost fees, etc. But that way they can access rates that are almost on par with what conventional rates are currently for regular home buyers. So it used to be that non-QM mortgages were significantly higher. Like I remember back in 22, you would have mortgage rates were 2 or 3% at the time, and then non-QM loans were 6 or 7%. Now, regular conventional loans are still in that like 7% range, and non-QM loans are going to be in that 7% to 8% range. So again, very comparable to what regular QM loans are. And yes, they're always going to be potentially slightly higher just because of the nature of that loan. It's a little bit more risky for that investor to pick it up, and there's a little bit less liquidity in that market because there's no GSC or government sponsored entities like Fannie or Freddie that are as large as them insuring non-QM loans. So again, it's always going to be a little bit riskier, so that's going to lead to the pricing difference there. But here's the point that I always make with my self-employed clients. You're going to pay, let's just say it's 0.5% more for your interest rate with a non-QM loan versus a traditional mortgage. If you're paying $2,000 to $3,000 extra a year in mortgage interest, the amount of money you're saving in taxes by writing off what you're writing off more than offset any difference in interest rate, even if it was 2 to 3% higher. But again, currently it's not that, the spread's not really that high. Again, it's about 0.5% to 1% depending. And again, you can always get that interest rate lowered by paying additional points, fees, etc. And the other thing to consider too is that mortgage interest is tax deductible if it's your primary residence. So again, if you're paying a little bit of extra interest, okay, you get extra tax breaks when you file. So myth number 4 is that you cannot use gift funds. So you actually can use gift funds on most non-QM mortgages. Now, gift funds, typically they're only going to be allowed for primary residential purchases. They're not going to be allowed for investment properties and things of that nature. But again, yeah, you can absolutely use gift funds for non-QM loans. All right, myth number 5, non-QM loans are only for bad credit. So I would say that's actually the opposite. Most non-QM loans, you actually need decent credit to qualify for, right? So I always explain it this way. If you have credit that's a little bit lower, but you got good assets and good income, you're going to go with an FHA loan in most cases, right? If you have, solid income and you have good credit, but you have no assets, down payment assistance. That's what we're going to look at. And if you've got good assets and good credit, but you don't show a lot of income, that's where we pull in a lot of these non-QM options for you, right? So think of it like a tripod. You've got 3 legs on that tripod, but if 2 of those legs are a little shaky, it's not really going to work out that well. And so again, with non-QM loans, there are some options there for lower credit borrowers, but typically you do need solid credit like 660 and above for most of the programs that we're going to be talking about. All right, myth number 6, non-QM loans take forever to close. So this can be true, and I've experienced it, a few times myself as well. And a lot of times where, you have loans that take a little bit longer to close. So when these loans do take a little bit longer is when the borrower does not get us the documentation that we need in a timely manner. So if you're applying for any type of loan, whether it's a mortgage, for a purchase or refinance or etc., really stay on top of the documentation that you need to submit to keep your loan moving through the process. Now, on my end, when it comes to my interactions with non-QM loans, we can get those closed just as quickly as we can get closed any other transaction that we have. Again, it really just depends on how quick that borrower is to get us their documents. And in most cases, these applicants are business owners. So, they do have a lot of stuff going on and they're very busy. So, again, where a regular client might be able to get me documents on a Tuesday after work, that business owner, they might be plugged up from Monday until Thursday and only have a little bit of time Friday to get us their stuff. In those cases, typically I'll lean on maybe they have a secretary that can get those documents over to me. Maybe they have a CPA that I can reach out to, or some professional that has their documentation. We can send them our borrower's authorization form and they can send us the documents as well. All right, myth number 7 about non-QM loans. You need 20% down. That's simply not true. Most non-QM loans will allow you to go down to about 10%. They do want you to have some skin in the game on this one. So you're not going to get a lot of down payment assistance options. You're not going to get a lot of, down payment options really below 10%, but 10, 15, 20% down, you can easily do on any of these loans or more. And again, the more you put down, the better pricing you're going to get. So I will say that, is very true, but you don't have to have 20% to put down to qualify for one of these. Myth number 8, you cannot use them on investment properties. So there are specific loans that are non-QM that are for just investment properties. So we're going to talk about a DSCR loan. So what that means is debt service coverage ratio. So very simply how we qualify that loan is if you're looking to purchase an investment property and you have the 20% or 25% to put down depending on what pricing you want and what program, you'll purchase a home, you'll put down that 20 to 25%. And what you'll use is the appraiser, and what will happen is when the appraiser goes out there, if the home is vacant, they'll give us, market rent on that property. And even if it does have a lease on it, they'll still give us that market rent. So we'll use the lesser of any current leases or what the market rent is on that property, and we'll qualify the home based off of that rent. So let's say your mortgage payment's $1,000 and, your market rent is $1,250. You would qualify at that point, and we don't have to do any income verification for you, the borrower, because we're actually just lending on the property and its ability to cash flow. So that's called a DSCR loan. Typically for those, you're going to need at least a 1-to-1 ratio. So if it's $1,000 on your mortgage, you need at least $1,000 a month in market rent. And then most loans they'll want you to be around, 1.25%. So it'll be that $1,250 when your mortgage is $1,000. So that's a really good one to bust, saying that, you can't do a non-QM loan on an investment property, because you absolutely can. Myth number 9, you have to verify employment the traditional way. So traditionally, to verify employment, we had to get some kind of employment verification form filled out by a manager or a supervisor or the owner of a company, depending on your position. With non-QM loans, more often than not, that borrower is self-employed. And so with self-employed borrowers, typically what we'll do is we'll get their tax returns in, and then we'll also pull the IRS tax transcripts to verify that what you sent us is also what you filed with the IRS. Right? Now, when it comes to non-QM loans, we're not typically using tax returns. We're using things like bank statements and other things, we're using things like bank statements, profit and losses, 1099s, etc. So how we verify that is we're getting your bank statement so we know exactly what you're making. And then what we also do on top of that is we'll pull up like the Secretary of State website. So for Indiana, it's like inbiz.com. And we'll actually search your business on Inbiz to make sure, that the date of filing for that business matches up with the timeline that you told us of when you opened your business. And then we'll also make sure that it's still active, that you as the borrower are actually the person that's running the business, if that's what you put on the application. So yeah, those are things that we do to actually verify your employment behind the scenes. Most borrowers don't even know that we do that, and so yeah, if you're looking to qualify with a non-QM loan, just know you need to make sure your in-biz affairs are in order. So, all right, myth number 10, interest-only loans equal no equity gain. So I personally don't do a ton of interest-only loans. Most of those are going to be like in the home equity line realm, or, in potentially some other, non-QM programs that I just haven't done a ton of. But when you're doing an interest-only loan, everyone thinks like, oh yeah, you're not gaining any equity because your mortgage is $300,000. And let's say your rate's, 10% a year, right? So you're paying $30,000 a year, which breaks down to about $2,700 a month. That's going to be your interest payment. And you're not actually paying off any of the loan, right? Which obviously that's true if you're making interest-only payments, you're not paying off any of the principal of the loan. But that property that you have is still gaining value over time. In most cases, in most markets, that home's going to go up 3 to 5% per year. So let's say after 10 years of you owning that home, if it's interest only, which I doubt it'd be interest only for the full 10 years, but let's just pretend, you would, if it goes up 5% a year, it's going to go up 50% over 10 years. So now that home's worth $450,000. You still made 150 grand, in appreciation in equity on that property without really paying off any of the principal. So again, I'm not a huge fan of interest only loans. I know that it does check boxes for certain borrowers, and in certain applications, it makes a lot of sense. But again, just because you have an interest-only loan does not mean you're not making any money on your home. All right, myth number 11, you cannot refinance later. So this is simply not true. Most non-QM loans, there are potentially some prepayment penalties. It just depends on what product you have. Typically, it's going to be for investment properties. It's not really on primary residences that I've seen. But, prepayment penalties may be like 3 to 5 years. So, again, just make sure that you're reading the fine print, talking with your lender, having those conversations, and understanding, what loan you're getting into. But as long as you're making your payments on time, you're keeping that income up and your credit in a good position, you'll always be able to refinance into a cheaper mortgage should those rates become available. All right, myth number 12, they're not allowed on second homes. So you can absolutely get a non-QM loan on a second home, like a bank statement, profit and loss, 1099 loan. Those 100% you can do on a second home. Another thing that people don't know about is in certain markets, you can use a DSCR loan to qualify for a short-term rental. So think like Daytona Beach, like Myrtle Beach, a lot of these places where Airbnbs are very popular. So if there's a market where Airbnbs are extremely popular, appraisers are going to understand that market and see what the average short-term rental would be for that particular home. So if you were to purchase a home with a DSCR loan and you're able to qualify based off of short-term rental income, there's no reason you couldn't stay out there maybe 2 weeks a year and enjoy your own little vacation out in your investment property. All right, myth number 13, non-QM loans are the same as subprime loans. Honestly, I used to believe this as well. When I first got in the business about 7 years ago, where I'd seen The Big Short and I was like, okay, these subprime loans are not verifying income, they're not verifying assets, whatever it is. And in the non-QM space, we now have some of those products back. Now, the difference between subprime and non-QM is that non-QM, again, you typically have to have a really good credit score to qualify. And even if we're not verifying your income or anything of that nature, we're still verifying your assets, and you have to put down a large amount of money. So again, think of that tripod. Maybe one of those legs we're not really verifying, or we don't have a lot of information on, but those other two legs are more than compensating for that, to the point where, the default rates are still super low on non-QM loans. All right, myth number 14, these loans don't follow any rules. I think that if you've been watching the video for this long, you understand that there's a lot of actual rules that do go into qualifying non-QM loans. And so again, that's simply not true. We're still doing a forensic deep dive on a client's application and their situation to verify that they do have that ability to repay, or they have a significant equity stake in that property when they purchase it, which for most people, they wouldn't want to lose the $40,000 or $50,000 they put into that home. So they're going to find a way to make that payment. All right, and the last myth, number 15, is that non-QM loans are risky. Again, default rates are super low on these. We do have to verify a lot of information for you to even qualify for this. So coming from, a mortgage expert, non-QM loans, they're not really scary at all. As long as you know what you're getting into, you have that deep discussion with your loan officer to know all the ins and outs of that product, how you're qualified, and make sure that the payment you're given will fit in the monthly budget that you have. So if you're getting a lot of great information from this video, please share it with a friend who's self-employed and is looking at potentially purchasing, some real estate. I want to make sure we're helping as many people as possible, growing the channel, and also giving you guys great information for you to start your real estate journey. So in closing, non-QM loans are not a last resort. They're a powerful option for people who've built income outside of the box. Real estate doesn't reward the traditional buyer. It rewards the most prepared. So remember that when you're going into your next real estate endeavor. Please subscribe for more myth-busting mortgage content. I'm going to come out with this segment probably about once a month. We'll do. Drop your questions in the comments. I reply to every single person. And if you want to find out if there's a non-QM loan that fits your situation, I'm licensed in Indiana, Illinois, Tennessee, Michigan, Florida, and Georgia. So if you're looking in any of those states, please, drop a comment below, or there'll be a link for you to get time on my calendar. More than happy to talk through any scenarios that you have and help empower you as a new potential homeowner. So thank you so much for coming to this video and watching it all the way. I appreciate it. Make it a great day.